Hey everybody, welcome back to another Buzzsaw Tax Tip Tuesday, powered by Duckett Ladd, Dental CPAs and Advisors. Jared Duckett back at you with my business partner, Buzzsaw. Buzzsaw, what's happening, buddy?
Hey, Jared, I'm doing great. How are you doing?
I'm doing good, man. And we kind of got to the end of this 5-part series. Again, you guys are probably getting tired of vehicle videos, but there's a lot going on here, as you can tell. And if you get, again, I'll stop you if you haven't watched the other 4, go watch them, subscribe, get the notifications, so you see this stuff. But we're going to kind of put a bookend on this series here. And really what we're going to do is just dive in, Buzzsaw, and do a case study. You've heard us say what the standard mileage is, actual depreciation, all this stuff. We're kind of going to put all this stuff we've told you guys to work and see exactly what it looks like. So let's just jump in, Buzzsaw. We're going to share a screen, kind of go through a spreadsheet we use internally, and then walk you guys through a case study, if that's cool.
Yeah. So here's kind of that case study that we've been talking about, kind of showing you the difference between actual vehicle expenses and standard mileage and kind of when it would be advantageous to use either one. So kind of our assumptions going in, that you drove 10,000 miles, 8,000 of them for business use, giving you 80% business use on the year for your vehicle. We'll start off going through the actual expenses here. And the big one, like we talked about last week, is that depreciation number. And so what we did is we assumed a new vehicle to you, doesn't have to be a brand new, but just new to you, that you purchased for $30,000. And of that, you can take bonus on 18,100 of it is the limit. And so this 14,000 number here is 80%, since that's what your business use was for the year. And that 80% is kind of extrapolated down through the rest of these expenses. These should all be fairly reasonable to what you would expect to see during a year of vehicle use at 10,000 miles. Maybe you didn't put tires on, but we'll add that in there. And so you can kind of see that really, you get a huge benefit here of doing the actual expenses, especially with that depreciation. If you have a vehicle that you purchased, it just really blows the standard mileage method out of the water as far as what your deduction you could take for 2021 would be.
Yeah. Let me jump in there real fast, Buzzsaw, because you can tell, like, right off the bat, man, that's a lot of depreciation that first year. And correct me if I'm wrong here, but 80% business use, so that puts them over the 50%, which gets into the 179, the bonus aspect. If, and we won't go through different scenarios, we're going to stay with our case study, but if that percentage were a lot less, let's say 30%, that depreciation number would look totally different, right?
Yeah, you might be looking at a couple $1,000s instead of 14,000, which that would, we can run the number real quick. That gets it a lot closer, 500 versus 5,500. Yeah.
So the depreciation is the big number that's going to push the actual, over. But I would say a lot of times, and again, I'm regurgitating what we said in videos, but a lot of people just depreciate the vehicle on the actual method. And I say they forget, but they forget all this other stuff. Just go through their licenses, gas, oil, tolls, taxes, interest, all that gets added to depreciation. So it's not just depreciation or standard mileage. Depreciation is a component of the actual method. And all the other actual expenses you can add to. I think a lot of people forget that sometimes.
Yeah, that's right. And then remember too, if you're doing the actual method that first year, you got to stick with the actual method. You can't switch to standard in future years like you could if you started off standard. You can flip back and forth between standard and actual.
Yeah, and that's a great point too, Buzzsaw, because the first year, I'm going to say election. It's not really an election, I guess, but the method that you elect to take is a big one. And so not every year in this example, right, are they going to get I want to say $17,888 deduction for that vehicle. Because I don't know if you know this, but like, what would year 2 like? Year 2 actual, let's say the expenses are the same, if you will.
Yeah.
Depreciation is going to change, right?
Yeah. So we kind of ran the numbers, and in year 2, the depreciation would be about 3,800 instead of that 14,000. So $11,000 less
Mhm.
in year two as far as depreciation goes.
Yeah. So still more, if you kind of did that, it'd still be more than the standard mileage method. But then every year that depreciation is going to tick down just a little bit. Is that right? Over what period is that again?
Yeah. So with bonus, it's a 6-year period, and year three was about 2,300. Year 4 and 5 about 1,300, and then year 6 is about 700 in depreciation. If you continue that 80% business use.
That's a big kicker, right? And it's a good thing to say 80% changes every year. It's not just always 80% that fluctuates with that mileage you guys are tracking, right?
Yeah.
Everybody out there is tracking the mileage. So that's going to fluctuate every year. So Buzzsaw, with that being said, eventually in this scenario, if we were to literally case study out all 6 years, whatever, let's say you kept the vehicle 6 years too, it's the pendulum's going to kind of swing if all things are consistent to where the standard is more advantageous. But that's why it's so important, right? Is to look at the 6 years in the aggregate as what they look like combined, right?
Yeah, that's right. Because like we mentioned earlier, once you use that actual method the first year, you're stuck with that for that specific vehicle. But the large benefit you're getting in year one probably outweighs the difference between the actual and standard in year 4, 5, and 6, because it still should be pretty close. Standard probably would have given you a little bit of a benefit, but I mean, you can see here year one getting just quite a large benefit with that depreciation number.
Yeah, for sure. So just talk about, I mean, viewers are probably looking at this like, well, yeah, it's a no-brainer. I want to do actual on this. And we encourage you to extrapolate out all 6 years and really see. But yeah, for this vehicle type, it's going to be more advantageous for the actual. What would have to be true, or what is typically true, where the standard mileage is more beneficial to do it the first year and go?
Yeah. So if you remember from last week, we kind of talked about, well, what if you already have your vehicle and you start a business? Can you take depreciation on that vehicle? And the answer was yes, but you have to take depreciation on the current fair market value of that vehicle. So say you have an old beater with 100,000 miles on it already, and the fair market value of it's not very much. Well, your depreciation amount's not going to be very much. So at that point, it might be advantageous to start off with the standard mileage rate, especially if you're going to be driving a lot of miles for whatever job you have. That would probably be advantageous then in that scenario to start off with the standard mileage rate.
Yeah, no, you're exactly right. That's a good rule of thumb, right? Low cost, high mileage, typically standard mileage. The reverse is the truth as well. So you got high cost, low mileage. In this scenario here, it's a perfect example. I say high cost nowadays, $30,000 isn't crazy for a vehicle in your example, but it is low mileage. 8,000 miles, business miles, is pretty low in a year, I would say. So perfect. I just want to point out one thing, and I might segue into another video here, just thinking through, the depreciation here is a big deal, and that's a deduction, right? That's a deduction that you take on your return. And I will just emphasize that depreciation is a timing difference. You're taking the depreciation now as a deduction, but, and this is a segue into a future video, Buzz, I'll just hit my mind, we can do is what happens. Let's say they ride this car out for 6 years, 7 years, it becomes fully depreciated. What happens then once they trade it in or sell it? And what happens with depreciation recapture and that sort of thing? I'm not going to go down a rabbit hole, but for another episode, you want to keep that in mind too. So perfect. Buzzsaw, I think this accomplishes exactly what we wanted to see. Again, I think the key takeaway from really these series that we do are just pure education. You guys consult your CPA, your tax expert to get the nitty gritty on exactly how all this works. But you as a taxpayer need to have a high working or high level knowledge of roughly how things work, so that when you go out to look at purchasing a vehicle, you understand the concepts, right? Maybe you need an SUV, 6,000 pounds. Maybe that's more beneficial. I didn't go over that here, but did in the last video. But exactly what you can start jotting down to try to get an estimate of what it would look like once you dive in. So Buzzsaw, I think it's great, man. Any parting comments before we jump off here?
No, I mean, just, proper planning. I mean, just kind of think about all these, these videos we've shot over this 5-part series, and hopefully it's giving you guys a lot of stuff to think about when it's time to purchase another vehicle and start planning for the tax ramifications of that.
Yeah. And that's what I would say too. I would say, if you're not utilizing a vehicle deduction right now in your business, for the most part, I'm going to caveat this, disclaimer. For the most part, you can utilize some portion of your vehicle for business purposes. Sometimes maybe it's only 10%. Sometimes it might be 95%. It totally depends on your exact situation. But if you're not utilizing some sort of vehicle deduction, ask your CPA, your tax consultant, what have you, hey, this is how I utilize my vehicle. Am I eligible to get a deduction? Because for the most part, probably the answer is yes. It really is just from there, how much to a degree of what that looks like. So anyway, Buzzsaw, appreciate you, man. A lot of vehicle stuff. We'll go from here, future episodes, and just constantly put stuff in you guys' head about tax deduction strategy, things you need to be thinking about. But Buzzsaw, appreciate you as always, buddy.
Yeah, enjoyed it.
You betcha, man. Everybody out there, have a great week. We'll talk to you guys soon. We'll see you.
See ya.